The primary source of profit for short premium positions is IV contraction. And you know what? I need a little IV contraction, and it ain't happening right now.
No, it is not.
The
Volatility up
VIX
60 cents. It doesn't.
The VIX futures this morning are up 70. What do you got them up? 70 cents?
55 cents if you're looking at the J's, which are the new front month. Yep.
No, I was looking at H's. Yep. J's. H's is going to be March.
Mm-hmm.
J is May.
Yep.
Got it. And the VIX itself is up a little bit this morning, too.
Yeah, VIX is up. It's up 36 cents. That's a 1% move to 28 and change.
Yeah. So we're not getting any volatility contraction this morning. However, since the extrinsic value of an option decreases with time due to theta decay, it's still possible for a short premium position to be profitable without significant changes in implied volatility. It is possible. It's just painful. Let's look at how profitable short premium strategies can be when implied volatility is sideways. It's the world we live in right now.
Mm-hmm.
So we did a study, 2017 to present, 8 years, 16 delta short strangles, 45 days to expiration, managed at 21 DT. We looked at sideways markets, meaning that the implied volatility moved plus or minus 5%. For those occurrences, we determined the POP, the average P&L, the average premium, the average return on investment. So lots of stuff. But here's the whole key to this study today. Plus or minus 5% higher or lower. So IV is kind of dead. 5% is nothing.
5% is nothing. You got a 3% move today, and we're basically unchanged in the market.
Yeah, 5% is nothing. So we're looking for 5% moves and in implied volatility, which is sideways. Okay, let's go to the next slide. So the table below represents the performance results of a short strangle based on implied volatility changes ranging from -5 to +5. So that's if nothing freaking happens. So the IB change between -5 to 0 and between 0 to +5, and you can see the probability of profits. Anyway, let me just think of, let's just take, when we look at this slide, thinking, hey, is there a big change in the -5 to 0 or 0 to +5? And the answer is a little bit in the POP.
Yeah, I was gonna say, because you got to fact. I mean, that's a 6-7% differential between the two. I guess statistically, that's going to be significant, right?
Yeah. So clearly, when implied volatility just pops up a little bit, there's more opportunity, which is what we always say. It's not humongous, but it is significant enough. I'm going to guess.
The P&L jumped a little bit with that.
It's about 10%.
Yep.
All total. So theta decay can increase our odds of success when using options, but over time, an option's extrinsic value decreases. So what would offset this benefit? Adverse price movement, like you could argue we're seeing that now.
Sure.
IV expansion. Okay, the options gain value, completely negating the benefits of theta decay. And sometimes could be early assignment risk, but I'm not too worried about that. Doesn't come into play. Okay. So 98% of these sideways occurrences happen when the VIX was between 0 and 30. Well, yeah, of course, because the VIX is always between 0 and 30, just about. 77% took place when in low IV between 0 and 20. 21 took place between 20 and 30, which is where we are right now. So the first thing that jumps to mind here is the chances of a sideways move right here is pretty low. It's about 1 in 5.
Right.
You're not going to see a lot of sideways moves. Okay, that's good to know. Most of the sideways moves happen when volatility is lower. And also you can see right here the total number of trades. When implied volatility is mid-range, it's about a quarter of the number of trades if you were to, in lower IV. And so I think that's interesting too. And so we just broke it all down so you can kind of see. And we're in that mid-range right now. 41 trades were -5 to 0, and 54 trades from 0 to +5. And you can just see the percentages there.